All right, let's jump right into this brand new explainer breaking down the critical May 12, 2026 CPI report and exactly what it means for your portfolio. If you've been watching the markets lately, you already know the vibe has completely shifted. For months, we were riding this really comforting narrative of disinflation. It kind of felt like the economy was smoothly gliding down to normal and the worst was behind us. Everyone was gearing up for rate cuts. But this report, it's a glaring red flag telling us that the smooth ride is officially over. So, why does this specific data release completely flip the script? Well, because the inflation problem isn't just about volatile energy prices or temporary global shocks anymore. We are seeing a genuine, distinct re-acceleration in core inflation. When the underlying everyday costs of living start creeping back up, the Federal Reserve is suddenly staring down a much stickier, far more complicated mess. The easy fixes are totally gone, and the stakes for the broader economy just got a lot higher. Here's our roadmap for today. First, the April inflation plot twist. 2, unpacking the core data. 3, the bull versus bear case. 4, key catalysts to monitor. And 5, your actionable investment playbook. Okay, part 1, the April inflation plot twist. Let's look at how a simple energy shock morphed into a much more stubborn macroeconomic headache. First off, the headline number. We saw headline CPI jump to 3.8% year over year. That beat the 3.7% consensus, and honestly, it is a pretty uncomfortable leap from the 3.3% we saw previously. Plus, month over month, headline CPI rose 0.6%. So right off the bat, these optics are the exact opposite of what the market, and especially the Fed, wanted to see. We were supposed to be trending down, not taking a sharp step back up.
But here's the absolutely crucial point, a 0.4% month-over-month jump in core CPI. This is the metric that strips out the crazy food and energy swings to show us the true underlying trend. And you guys, it literally doubled the 0.2% pace we had in February and March. Year over year, core bumped up from 2.6% to 2.8%. This basically paralyzes the Fed. They're totally boxed in at their current 3.50% to 3.75% rate, unable to easily cut and stimulate growth while underlying inflation is actively ticking back up.
Moving into part 2, unpacking the core data. Let's deconstruct this report and look at the actual engine room driving these scary numbers. Now you might be thinking, hey, can't we just blame this all on the gas pumps? I mean, the data shows gasoline skyrocketed a massive 5.4% in a single month. It's up over 28% year over year. And fuel oil? Up a staggering 54% annually. If you filled your tank or heated your home lately, your wallet definitely felt that. So, it's totally fair to ask, is this really just an energy story dressed up as a broader crisis? Well, energy definitely played the villain here. According to the Bureau of Labor Statistics, energy accounted for over 40% of the entire monthly all-item CPI increase. That is a huge distortion. When one single category carries nearly half the weight of the whole inflation bump, it absolutely skews the overall picture. But actually, scratch that. Energy is only part of the story. Because alongside that massive 5.4% gasoline spike, core components are just marching relentlessly higher. Shelter rose 0.6% month over month, and services excluding energy went up 0.5%. What this tells us is that the breadth of inflation is actively widening. It's not just the gas station draining your cash anymore. It's your rent, and it's the everyday services you rely on. The price hikes are spreading out. When we sort all this noise into sticky versus flexible inflation, the whole picture clears right up. Flexible prices, like gasoline and fuel oil, are wildly volatile and they're dominating the headlines right now. But the sticky stuff, shelter, core services, even airline fares which jumped 2.8%, those are refirming. And these are notoriously hard to cure once they set in. Think about it. When was the last time a landlord actually lowered your rent? Once service providers bump up their baseline fees, those new prices tend to stick. And that is exactly what limits the Fed's flexibility moving forward.
All right, part 3, the bull versus bear case. 2 diverging paths for the economy. This mixed bag of data puts the market at a massive fork in the road.
Let's weigh the scenarios here. The bull case essentially argues we're just seeing delayed disinflation. It views April as mostly a temporary glitch, just some geopolitical noise and energy spikes. In this optimistic view, oil eventually stabilizes, headline inflation cools down, the labor market holds steady at 4.3% unemployment, and the Fed can still eventually swoop in with rate cuts to nail that elusive soft landing. On the flip side, we've got the bear case, the stagflationary trap. This perspective treats higher energy costs like a direct tax on households, and that tax is going to bleed into services, squeeze corporate profit margins, and just crush real purchasing power. Because core inflation is rising, the Fed can't ride to the rescue with cuts. That leads to an earnings squeeze, meaning investors will demand a much lower price for every dollar a company actually makes.
Which brings us to part 4, key catalysts to monitor, mapping the data releases ahead to see which path we are actually on. So how will we know for sure? It's a literal countdown over the next month. 1 week from now, we need to eyeball the Producer Price Index, or PPI, to see if wholesale costs are bubbling up before they even hit the consumer. In 2 weeks, April retail sales are absolutely critical. Are consumers retreating because of high gas prices? Week 3 brings the April PCE, which is the Fed's absolute favorite metric because it tracks what consumers actually spend, not just sticker prices. And finally, the big one. In 4 weeks, on June 10th, the May CPI drops. That report is going to officially confirm or deny if we are in a broader inflation relapse.
Finally, Part 5, your actionable investment playbook. Let's translate this into a cross-asset strategy for a higher-for-longer regime. Now that we've got a grip on the macro narrative, the primary takeaway from the source material is crystal clear. This is absolutely not the time for indiscriminate panic. Instead, we need to adopt a selective defensive tilt. It's all about favoring high-quality assets with bulletproof balance sheets over pure beta. We can't just blindly ride the broader market wave anymore expecting everything to go up. Easy growth optimism, that's on pause while we navigate this intense inflation uncertainty.
Here is the exact cross-asset playbook you need right now. For equities, rotate into defensive sectors. Think energy, healthcare, staples, and defense. You really want to avoid rate-sensitive growth stocks and small caps that heavily rely on cheap borrowing. Over in the bond market, expect 2-year Treasury yields to stay sticky or even move higher, since rate cuts are getting pushed way out. That guarantees a persistent curve inversion, where short-term rates actually pay out more than long-term ones, which, as we know, is a classic economic warning sign. Looking at commodities, gold remains highly constructive as your geopolitical and policy hedge, and oil looks supported in the near term. And guys, a really vital note on crypto. Treat Bitcoin and Ethereum tactically right now. In a world where core inflation is hot and the Fed is frozen, crypto acts like a highly vulnerable, liquidity-sensitive asset, not the reliable inflation hedge some hope it to be.
I want to leave you with this one final critical question. Consumer sentiment has already dipped down to 48.2, with everyday people explicitly pointing fingers at gas prices and tariffs. As inflation momentum steps up and the narrative clearly shifts to a headline shock plus a broadening core reality, you really have to ask yourself, can your current portfolio survive the Fed keeping rates restrictive for the foreseeable future? The data's telling us that the soft landing just got a whole lot harder to stick. Review your exposure, focus on quality, and keep your eyes peeled for that June 10th CPI release. Thanks for joining me for this explainer, and stay sharp out there.